So what are the numbers telling you? Because what's being shown on the ground is this slowdown in consumption, people really not wanting to spend.
Yeah, look, the numbers are telling us that it's a year of a middling recovery, which is not what the markets at all expected or wanted to see, of course. On the consumer side, you're still seeing the revenge spending basket, quote unquote, things like travel and dining out. Those are actually remaining pretty strong through the summer, needs to be noted. But when it comes to goods, luxury goods, autos, furniture and appliances, et cetera, you're seeing a pretty sharp pullback now in July by the consumers.
What's happening there? Because we thought that retail sales were starting to improve, especially around June. And will the latest measures, and I'm really starting to lose count of how many measures we've seen from Beijing, are those actually going to help in really shoring up confidence in China?
Look, they may help along the margins. They are incredibly targeted. The idea has always, well, the idea for this year has been that we're not going to do big bang stimulus. There's no bazooka being shot at the economy. So you may see improvement into, the fall and so forth. But I think consumers are going to remain cautious. They're going to spend on one thing or the other. They're not going to spend across the board.
Shehzad, 5% growth, if they manage to get there with some of these support mechanisms, it's not horrible, right? Is this a case of kind of having to shift our expectations into the longer term of what the Chinese economy looks like after, of course, decades of just supersonic growth?
Absolutely. The first thing I think, investors have to reorient how they think about China. The era of 6% growth, 8% growth is gone and gone forever. We're looking at sub 5% growth for sure moving forward. Maybe even 2-3% very soon here. And by that standard, Beijing doesn't have a lot of pressure on it to do big stimulus. I think a lot of the market's expectations at the beginning of the year were just vastly overshot, and you've seen as a massive overreaction to all of that for the rest of the year.
The issue of capital, both for households and more broadly, is interesting to me because we know there's a closed capital account. There's very few kind of avenues how households can invest their excess savings, right? Hence why they're sitting on a lot of it. That doesn't square with what we saw in that previous package, the overall sentiment of ordinary people saying that they don't feel wealthy or they feel poor at this point.
There has been the deflating of the property bubble, which was a policy choice that was made, has led to wealth destruction. What it means today is that consumer confidence is being directly hurt because one of the few avenues of investment and creating wealth in the country has been essentially destroyed.
We saw the Politburo changing its tune and then perhaps signaling some easing of those policies in the property sector. When can we expect that to make a difference?
Look, it's going to take a while for that to really make a difference for folks to go out there and try to get a house again, or perhaps even think about getting a second home. In our numbers, we're seeing things like mortgage rates go down. We are seeing some housing sales improve in certain quarters, but it's not an economy-wide a trend at all. And I expect it to remain very, very choppy moving forward.
What are the takeaways for investors? Because I note that, in the recent data, you've seen selective parts of the Chinese consumers still strong, some parts of that revenge spending, travel, leisure. Do you think that will extend to further strength when it comes to luxury? How would investors be wanting to get exposure to the strength that is still there?
Yeah. I think when we look at what the bullish signals are, perhaps in the data, you are seeing a pickup in fiscal activity. It's very small, but nevertheless an improvement, which tells you that, look, you are going to get some amounts of targeted stimulus, including on the fiscal side. That's a positive signal. On the whole, however, markets should prepare for the fact that this is going to be a year of much more modest growth than they were hoping for, and that includes much more modest stimulus than they thought would happen back in January or even February.